Hi guys, it's Crypto Burp Adrian speaking. Welcome to today's Friday webinar. Major significant changes in the macroeconomic situation all over the planet. The bear market actually strikes even stronger on the stock market, also hits Bitcoin. All that amidst geopolitical tensions, amidst galloping inflation, which is very, very hard to stop and in fact seems unstoppable, even though we actually had the 0.75% rate hikes for the first time in a very, very long time for the US. We're going to discuss this and more and how it all connects and kind of like try to summarize, wrap up what can be actually on the horizon for the next days and weeks for Bitcoin, for other cryptocurrency markets, as well as traditional finance. If you guys are ready, make sure you stay tuned. We are going to go there right in a second. Check. Please, guys, let me know how you can see me, how you can feel the vibe. If you guys are doing okay, hopefully, yes, the bear market actually had been confirmed for some time, but it actually got a little bit of more drastic scenario to the downside. Uh, Additionally empowered by the rate hikes unseen in a very long while for the US history, and all that amid geopolitical tensions. And before we go and jump right into the very details, I want to say that this video is sponsored by our amazing partners at PrimeXBD, which is an established platform where you can basically trade crypto, forex, commodities, all from one single account. And if you want to join PrimeXBD, get up to $7,000 deposit bonus. You have got a special coupon code BurbNest, and the video description is going to get you the link for it. Make sure you search for it there. And going there right straight in the very depths of the details. Let's give it a check. Hope you can see my screen. And well, Fed raises rates per the Wall Street Journal by 0.75 percentage point, largest increase since 1994. Okay, it's quite some time, almost 30 years. And well, Jay Powell, the chairman, actually said throughout the FOMC meeting in June that not only they did decide to get 0.75 rate hikes, which actually had not been promised. In fact, if you think about what Jay Powell was saying in May, they said there were no actual reasons to slow down the inflation by bidding it even with even larger stake, as in the rate hikes of 0.75% or 75 basis points. In fact, they were supposed to get this proper thing going for the 50 basis points, right? So we got, I think, a little bit of out of control, for for what the Fed is doing right now. It does seem that this inflation is not really coming off. Okay, the food and energy prices and the crisis is actually, not really letting the prices come off, which basically pushes the monetary governors to even more drastic tools and resources, right? So all that actually drains the capital out of the market, drains the liquidity, while the balance sheet of the Fed is basically getting reduced significantly. Okay, so all that amid economic slowdown, all that amid economic tensions, straight out of any kind of like order that had been managed to be given after the pandemic of COVID, right? So it is all kind of like a crazy setup. The bear market actually hits with the stock market, traditional finance aligning with the cryptocurrencies as well. This is all coming off together, even further even deeper to the downside, more or less violently, depending on where you look at. Okay, so this is all definitely not helping one of my favorite, institutional analysts, Mike McGlone of Bloomberg Intelligence, senior commodity strategist, is saying that bond future collapse makes Bitcoin look major. Okay, and that need to go back to near the start of U.S. Treasury bond future trading in 1977 for a similar drawdown as in 2022 is clear indication of level of extremity. And I do kind of like confirm that this comes from many different sources and angles, as in you get the situation, this unprecedented changes that you didn't see for the past 40, 50 years. It's pretty wild. It's pretty wild, right? And on top of that, we got from the Squawk Box of CNBC, we got this tweet saying, "I think it goes to $12,000 regarding Bitcoin, whether where it was before this whole fiasco began." Okay, says Jim Cramer. So this is kind of like, typically, reverse signal, if you will, right? There is an entire comedy account, I think, on Twitter that is basically called Inverted Jim Cramer Font or something like this, and they get a pretty high win rate, right? They get a really really high strike rate, which is very interesting as well, right? Media actually tends to many media stations tend to mislead you actually as the final kind of like users to and participants to the market. Okay, so this is pretty wild, and I do think that this saying itself may actually hint that some closer bottoming process may be going on, which it kind of like seems this way. However, it all needs to come out together, because we don't see so much confirmation of strength in the regular markets as in the traditional markets, with the Dow Jones Industrials, okay, are not really looking well. You're looking at a definitely 30,000 support, which is a very significant round number, being slightly violated to the downside. It's not the most bullish and the most promising thing you could get, right? This is something actually worse than better, if you were to guess. S&P 500, coming basically down below 3,700s, 30,000 points, okay, is something for the Dow Jones Industrial. But here, similarly for the S&P 500, after this massive, significant kind of like a sell-off with running gaps to the downside, you were looking at a triple gap down pattern, which typically kind of like confirms a very rapid sell-off. Okay, this very rapid sell-off adds to the extremity, okay, of the sell-off itself, right? Because you are seeing that this trend kind of like starts getting steeper, basically getting steeper and steeper, right? This is definitely what confirms this kind of like an inverted situation where you think of euphoria whenever there was, October, November 2021 for all the markets accounting, also including Bitcoin and cryptos. So all those things concerned, also for the DAX, for the German, basically DAX composite, it's not really doing so well. I guess, the easiest ways to summarize this maybe is if we go to the dashboard, and if we get this proper RRG chart, right, which is basically this relative rotation graph, you're looking at strong tail, okay, which is basically the velocity of the relative strength. This is for those who actually don't know, relative rotation graph tells you the story of the whole kind of like specific market universe in this context of different stock sectors for the energy, for utilities, staples, and so on and so forth, right? There below is a proper list, over the benchmark, and the benchmark is there right in the very middle of the of two axis intersection point. Okay, 100 is S&P 500, and all of the other sectors are measured and versus this benchmark. Okay, so the S&P 500 serves as a benchmark, and anything is actually put and measured against the benchmark for its relative strength momentum from JDK, which is from the name of Julius de Kampnauer, and JDK Eras ratio, which is the relative strength ratio. Okay, so we get the relative strength on the horizontal axis, and the vertical one, which shows you the momentum, so that you get to conclusion that this leading quadrant is basically the most desirable situation for if you're long. Okay, if you're long, you want to see strength and a high momentum kind of like amounts here, and same for the outperformance against the S&P 500. So all those kind of like in the green, okay, in the green section tell you that there is an outperformance of against S&P 500, both in terms of the relative strength and in terms of the momentum. So this is the relative strength, which is upwards trending, and it's actually accelerating to the upside. Okay, so this is actually this momentum principle, which tells you that the trends have tendency to persist more likely than reverse. Okay, the money that moves the market is actually what drives the momentum principle. And because of that, you want to look for, while spotting any reversal, you actually want to have as many stocks in the leading quadrant, okay, possibly to confirm some sort of like a strength against S&P 500. However, it all comes up, with the I think with the sector rotation model, right? And the sector rotation model basically tells you that depending on the economy stage, you get different asset classes, different stock sectors actually playing out well at different stages. Okay, so whenever there is a bull market start, which typically leads 6 to 9 months, the business cycle, the economy cycle, okay, you get to look at consumer discretionary, you get to look at cyclicals, right, which is the technology, which is also later the industrials, basic materials. You want to have them basically located in the leading quadrant. And if you look at it, this is a little bit of what we might be looking, right? However, there's still the very major in the green kind of like leading quadrant. You're still looking at, well, first of all, the energy, the utilities, which is a little bit of more defensive, XLP, which is the staples, which is also a little bit defensive, materials, okay, healthcare, a little bit of more defensive again, in industrial. So you get this combination of outperformance for the stock sectors, okay, being the combination of cyclicals and defensive markets, right? This is a little bit, I think, hinting that those sectors are performing, maybe getting us some hints about future reversal coming up, right? If you see a relative strength in those sectors which typically lead the financial market cycle from the bottom up, okay, I would guess that this strength is exactly what we want to see to confirm the major bottoms, okay? However, it's not necessarily set in stone. You love to see this getting confirmed. So the more the merrier in this case, and it does seem to be working out pretty well. And the price action wise, you're definitely looking at some deterioration. The price wise, for both on the indexes, for the Nasdaq Composite and the S&P 500. However, typically where you get this kind of like acceleration to the downside, you want to look at some exhaustion signals, right? And the fatter the gaps arrive down the trend, the bigger the chances are that there is going to be some reversal. I'm not saying this is necessarily the bottom, right? There is definitely some support also for let's say for S&P 500 at around 35 hundreds, right? This is typically where you want to kind of like have some this is a 50-day chart, 50-day chart. If you actually switch it for the weekly, okay, you're going to have definitely 50-week average working as a support. However, you want to see let's actually play it as a 200-week average. Okay, this is typically just like for Bitcoin, it is a very strong historical support, right? The less some deviations coming off the COVID spikes, which is not really predictable too much. You cannot predict when the next pandemic comes with a price chart. Okay, I mean, you could argue or some probabilities of the reversal if the economy is not robust anymore, but I would argue it's not possible to predict Martians attack on planet Earth with Bitcoin's chart, right? There are some limitations to it. So I would argue that we are sort of like approaching this very important historical support pocket, right? We get this decent price action prior reversals, which actually, later confirmed to act as a little bit of support later on, okay, throughout the history in 2022 and 2020, through 2020, basically after the COVID recovery. Okay, so this aligns and tells me that the entire area between like 3300s and 3500s, 3600s may actually be considered and anticipated to be some sort of like a bottomish region. All right, there are a lot of uncertainties that which you cannot basically predict, like again, next pandemics, new virus strains, or just geopolitical tensions, as in Russia-Ukraine war. You don't know when there is like some war development of the chart. So now it's a little bit still of a guessing game, but assuming there is not much change fundamentally, right? Just this monetary policy doesn't get tightened overnight, let's say emergently, much worse, in a much worse manner than it was before. Then I would say that we're looking for a bottom, okay, somewhere around these regions with a little bit of perhaps some, piercing through and reversing around those levels. That's just my guess. I would not recommend you actually play it just like this. Somebody, J Dog, is actually saying the recession is on the way. And I recently actually had this proper check of the conference board, economic indicators for the leading indicators, coincident indicators, and lagging indicators. And this overall conclusion that I had, in my private trading channel, for our premium community members, was that the economy is actually slowing down. You're looking at a slowdown of the GDP. You're looking at less robustness overall in the economy. This large monster that is actually, that the economy is getting is crawling a little bit slower, right? Those leading indicators were actually on the negative side, recently, which tells you that just the consumer spending, which is the very necessary aspect of U.S. economy robustness, or consumer sentiment, coming out from the high inflation and basically expensive foods and gas prices. You're looking at an overall negativeness, right? Negativity in terms of the expectations for the next 6 to 9 months. And while this is, not necessarily the sign of a recession itself, this tells you that there is a lot of deterioration in the way that the investors, the consumers, feel about the economy. And the way that they feel directly translates into the way that the economy is going to actually work over the next couple of months. And this also is additionally confirmed with one of the leading indicators, which has always been, at least in the recent history, somewhat of a good strike rate caller for the recession. We're talking about inverted yield curves, right? Or basically the interest rate spreads between the 10 years and the Fed fund rate, or 2 years. So all that things concerned, you're looking at a lot of uncertainty, a lot of slowdown, okay, a lot of deterioration in the way that the market participants feel about that, about the economy, okay, and at the same time, signs of early recession. While it is not necessarily into deep recession, because deep recession needs to be confirmed with at least 2 quarters of negative GDP growth, okay, you usually want to definitely have some sort of, I should say, look at the robustness of the economy. And the economy is slowing down. It's not necessarily the most robust it's been, and the inflation is very hard to actually stop it, right? This is exactly what Jay Powell also said on the recent FOMC meeting. So all those, yes, somebody's saying 72 watchers. I think there are more right now, because it's streaming directly to many different platforms. If you're watching that on YouTube, by the way, make sure you hit the subscribe button, smash the notification bells as well, so that you stay tuned and notified whenever you get the new updates coming out for you, freshly baked in the oven, each and every single day for you, free of charge. Okay. So all those things concerned, you're looking at the markets, okay, which have already seen a lot of deterioration. We're talking about basically the percentage change, okay, ever since the peak happened in early November, the very same day that the peak happened for Bitcoin. You're looking at 35% almost drawdown, okay, of the peak. Same story for the S&P 500, however, a little bit less drastic, 25% almost, right? This clearly classifies both of these major indices, well, in the bear market. So in the bear market, and it is actually very hard to predict the bear market before it happens. You see a lot of, divergences and then so on. However, you usually get to confirm the bear market after it's very apparent, right? So all those things concerned, we have to understand how Bitcoin is actually translating to those values. Okay, how those values translate to Bitcoin's performance. And here at the bottom, you're looking at the correlation coefficient, okay, of Bitcoin against S&P 500 on a 7-week basis. And you're looking at this kind of like, coming off the very, very highs, the extreme highs of, to the best of my memory, again, 0.93. So 93% correlation, positive correlation in terms of the S&P 500 and Bitcoin's movements, okay, moving in tandem in the same directions. It's definitely recently deteriorated sharply, okay, whenever Bitcoin, got this kind of like a Luna crash recently, okay, which basically destabilized cryptocurrency markets, and stocks got some decent upwards lifting up then temporarily. You're looking at another instance of a sharp upwards increase, okay, basically over the last 2 weeks of 0.47, okay, up almost double, well, some significant major increase for the correlation to 0.81 on the 7-week basis. This tells you, okay, that, well, having the bear market, of course, in Bitcoin, smashing through and destabilizing the previous supports after the Luna crash, you're looking at a lot of correlation. And typically when you get to see the crash in the market, okay, the markets tend to reunite, kind of like in terms of in tandem, and pull off this crash in tandem. Whenever the markets crash, right, they crash together. People are in this panic selling mode, actually selling off each and every single thing they can sell off at any cost, right? This very opposite of the euphoria, this irrational exuberance that you get on the very peaks recently, where people are feeling very euphoric about the markets. And this is the very opposite, right? This is some sort of like getting into this depressive, very high in the depression levels, with sentiment being at historical lows, right? I haven't looked at recently, but if we have a look real quick at it, you're looking at fear and greed index, which is in basically 7 or 9, right? This is reminding me a lot of what we had in this capitulation in the COVID crash 2018 minus capitulation, or what we are looking at right now. However, you have to account for the main, well, historical context, and Bitcoin likes to reverse, okay, with the certain range of drawdown. The drawdown basically measured from the peak to the trough of the bear market bottom. You're looking at typically somewhere between 80 and 90% of retracement, right? 80 and 90% of retracement is what you usually get off the peak. Okay, 2013, 1250 down to $150, right? Or the MT Gox actually took it down even more somewhere in some places. 2017 down to down from $20,000 off the peak, towards like 3120. Okay, another 84% decrease. So far, we are looking at 70% decrease. Okay, and the Barbicator Pro on the weekly basis actually, has been calling this bearishness ever since 2022 started. Okay, and ever since 2022 started, there was no basically clear confirmation level for the reversal. For now, the main threshold to invalidate the bear market, to escape the bear market, is set at 34,567. Okay, so until you get a proper close on the weekly basis above 34,000 or the mid 34,000s, you cannot really talk about confirmed reversal out of the bear market. Okay, so having actually broken, out of this range, out of this previous range that had lasted for a year and a half. This is by the way very, very I should say uncommon thing for Bitcoin to move sideways literally for a year and a half. Typically it's a very emerging market, it's a very strong trending market, right, with very strong trends driven by demand of retails and institutionals. However, the most recent, post-pandemic realm and the economic slowdown actually got us lower. And this got us lower into the very historical support of 200-week average, which is this black curve at the bottom, right? And while it is not necessarily the holy grail, I mean, as in, some people believe that while being long enough in the markets, you spot some holy grail, that you spot some 100% miracle success, strategy that is going to get you top and bottom predicted each and every single time for the rest of your life. While this is not true, there is no actual continuous pattern of winning it. Okay, the continuous pattern of winning it, other than any chart pattern that gets 100% win rate, is actually discipline in the way you manage your money, in the way you design your trading system, in the way you follow the strategy you follow. Okay, this discipline, the self-discipline, or the lack of it, as in the bias, definitely makes you underperform against the buy and hold strategy, right? So here, looking at this actual support of 200-week average, which had been historically proven to be very valid, you cannot really not account for it. Okay, so in my opinion, this remains very valid and historically relevant level to anticipate and to tell us, okay, what is considered relatively cheap on a historical basis. So $22,000 for the 200-week average basically tells you and validates that, accounting for the historical records, anything bought below 200-week average historically returned high ROI. Okay, there are multiple tests for it. Where you can Google that and research that as you will. However, it's even apparent pretty much visually that even for this market cycle, okay, even for this market cycle or for the previous market cycle, okay, it starts right here because from this moment you actually got only to see 200 weeks of price action on average. Okay, you're looking basically at historically important and relevant levels for the crashes to buy in. So accounting for again 200-week average support, okay, as well as the drawdown range, the historical drawdown range, peak to trough of the cyclical high and low, okay, giving you the range between 80 and 90%. Okay, this tells us that we are in the proximity of this potential bottom region, at least accounting for the history, right? While I do actually, get this significant change to my trading style and overall trading strategy, the way I look at it in the market, right? I do not necessarily try to predict the markets anymore. I mean, I just follow my strategy, which is the Burbigator Pro current time frame trailer trend following breakout system. This is what I do, and this is where I earn money, right? And I'm not going to enter any short-term positions until I get a confirmation for this major breakthrough. Okay, for this major breakthrough uh, above 25,100. Okay, $25,100. Is the main threshold that needs to be reclaimed in order to get this proper trend validity breakout. A valid trend breakout. Okay, and until you get it, I don't deploy any short-term capital, and I've actually recently started buying into the longer-term portfolio again. However, I still wait for some bigger confirmation in terms of the historical range, 70 to 80, 80 to 95 and to 90%. It's not there yet. I'm not saying, I'm not going to buy any, because the contrarian in me is telling me basically that the historical opportunity is really considerably good compared with the past historical records. Okay, then I do separate my long-term portfolio as in more on the buy and hold. Coming off the contrarian basis, which made me recently add some six-figure Bitcoin values, worth of Bitcoin. And yeah, my short-term capital kind of was safe for the vast majority of the time, because the current time frame trailer got no significant breakouts, so no significant invalidations were given to the bearish tendency. Okay, so this made me position myself mostly in cash this year, mostly in cash, especially since April. Okay, and this saved me literally from 50%, okay, of losses. So using this Burbigator Pro basically got me out of losing my capital and lose value by 50% to the downside. I think it's fair. It's pretty cool, right? So having this kind of again this understanding that the overall rate hikes tend to withdraw the liquidity from the markets. Liquidity as in total volume of money, total money, total volume, total turnover, makes the markets dry, leave it as a kind of like a dry powder, literally withdraw this, make it a vacuum, ready for the capital deployment later as we go. The market is still in this bear market phase. It's still in this bear market phase. We are going to search for some potential reversal symptoms. However, it's not yet given. If you guys want to get some questions answered, I'm definitely running out of time a little bit right now, but we get 7 days free access for you. So if you're serious about your money, if you have any questions, you can come up to the Burb Nest within our 5th year of working, since 2017's foundation, and get 7 days free. Just go to theburbnest.com, upper right corner, sign up free button, email address, first name, and we're going to set you up free of any charge whatsoever for 7 days free. Come up. It's a lot of fun. You're going to get some decent knowledge. If you guys appreciated that, make sure you hit the subscribe button, smash the likes, and leave some kind questions in the comments. I'll make sure, guys, to cover that as well after the show. I see you guys in the Burb Nest, 7 days free trial, theburbnest.com/free trial. God bless you all, and I see you around. Bye-bye.